So we've got the 2-year yields here up at the highest level since '07. They've shot up today. And you've got the Fed coming up the first couple of days of November. We are into the last week of the trading month next week ahead of the Fed. And we've got the dollar yen hovering up in the 150s. I've had a high today of 150.12. Now, the last time the Bank of Japan admitted to intervening, selling the dollar, was back on the day after the Fed hiked rates by 75 basis points last month, which was Thursday, the 22nd of September. And I've just written an article, I've just posted it. It's live now on FXStreet's website. So if you go to news, you'll see it there. US dollar is carving out the risk of an imminent downside breakout. US yields rocket to the moon, ? And back. So if we go to that article, so we're just talking here of essentially, where the euro is today, a little bit of background into what happened today in the markets and what's been going on this week. Fed speak, talking up interest rates, etc. Basically, we had Harker come out today and say that the Fed is nowhere near done and inflation is not where they want it to be. And that put a bid into the yields. Now, the dollar, although, it's recovered on the day. Let's have a look. The dollar was essentially lagging, really, following the spike in yields. It moved up, but still not extensively. So you got to wonder whether we're going to see a catch up there in the greenback. We're carving out this W formation on the hourly chart. On the front side of this trend line, which is a bullish scenario for later in the week, the sessions ahead. So you've got this W formation here. It's sort of been resisted over here. It's the high of the day. So there are prospects of a pullback, which we're already starting to see. The support area here would be expected to, support. All right, and we've got a Fibonacci 38.2 around the neckline area of the formation for a subsequent move to the upside on a retest. All right, so that's a potential scenario and a move higher. If we move over to the daily chart, and I'm just going to clean up this mess. I'll get rid of sessions. So we've got a similar scenario, right? Recognize the pattern. So we've got this harmonic W formation. Not only that, we've got this bullish flag within the pattern. So just something to note, really. And then if you draw your trend lines, in fact, instead of wasting time on this, I've done that all the way over here. So if we go to the chart that I've already drawn up, so, and I'm talking specifically about the euro, but we'll stay on the greenback for the moment because that's where we're at. So we're talking about a harmonic pattern, the flag, and the potential to move out. And then I was going to draw in the trend line, but it's already there for you. So you've got that micro trend line within the bullish trend itself. So just a thesis that the dollar has lagged behind the rally in yields, and we could see a burst up. Consequently, if we move back to the analysis, the euro is currently in sort of wedged into this, whatever you want to call it, symmetrical triangle, wedge, coil. It's being resisted up here below the figure, and we've had a subsequent move to the downside, and there are prospects essentially of a lower low. That's where I'm trying to get to with this. Zooming down onto the 1 hour chart, we've had this 3 push scenario up into the upper realms of the pattern, pressing up against a dominant trend line. And we have the breakout trend line of the symmetrical triangle, whatever you want to call it. So we've had a sharp move down. You often see that. You get 3 levels of rise and a strip out of longs. So this is essentially a long squeeze, which could continue into stops below, because that's where the money is, right down into this cluster of liquidity and support, potentially for a move up, and then to come back down, on the basis that the dollar remains strong into the Fed. Now, this is on an hourly chart, so of course we're well away from that. But the sentiment would need to continue in order for this to play out. And from a longer term perspective, I mean, this was a pattern I actually drew in, I think, at the start of the week, and we've seen that play out nicely. This is the opposite of the W that we saw on the dollar. So we've got this M formation, we've had a drive up, we've got this, the opposite of the Dixie, obviously, right? So we've now got this bearish flag within that M formation at resistance on the back end of the trend line. And these are the levels that I've pulled up accordingly as per the weekly template. So we've got last month's low, which is essentially the target, the interim, and a break off down to test 94, the figure, and lower. Again, this is all on the prospects of a continuation in the dollar rally. But when you throw in the spanner in the works, the Bank of Japan, which I talk about at the end of the article, you've got to be wary that they're on the prowl. And all these officials need to do is call up the dealing rooms and to spark off a flurry of essentially a long squeeze. So on the hourly chart, again, there's that harmonic pattern turning up again, right? So there's a lot of synergy here, obviously, and a pullback could be imminent into the what was a trend line area. We've had that a break of structure. So there's weakness coming in, and we could see that easily pull back very quickly, very soon. We had the potential intervention around the CPI data. So whether that was an official intervention physically or not, I don't think they admitted to it. So we don't know about that. But we do know about this one that was after the Fed hiked rates, and this was a drop of 500 pips, right? And this was about 100 pips. So if you're in a position, if you were buying that CPI data, you would have been wiped out, and your stock would have been a lot of slippage on the stop. So that it costs you a lot of money. So you've got to be wary of this. And then, obviously, You had the 500 pip move here um, on the day, um, the turn of the Frankfurt Open, and then you've got the prospects here in the yen falling below the trend line down to 149 for a deeper retracement. You've got the 149.90s, 70s, and then the figure down here. So I've just sort of eyeballed that as a cluster of liquidity. Presumably they're comfortable with it at 149. It's good for exports and so on. So that's where it sort of leveled out after the prior physical intervention. So I've just eyed it there, really. I mean, you can't, no one's got a crystal ball, but so there we go, really. I just wanted to bring that to whoever might be watching this, their attention. And then if you look at yields, I don't know, I didn't put the yields in for some reason, but we had a drop in yields, hence the title, to the moon and back. So yields have gone to the moon. Could they coming back? They could do just purely on the sentiment of Bank of Japan intervention. If you're managing a big fund or something, you don't want to be taking that risk of a 500 pip move in the yen, and then we had a sharp drop in the euro. A sharp rally in the euro when it happened, and a sharp drop in yields. So just something to be mindful of in the lead up to the Fed. It's coming to the end of the week. It's Friday. I don't know that the Bank of Japan will do anything today. Who knows? No one knows. But again, just the sentiment is something to be concerned about because we're a month away from the last intervene. So, whether they've got a plan to do it once a month. Obviously, they're watching this intently, so you'd think that they have a plan as to when to execute and so on. But who knows what that plan is. So I think that's all really. That's all I want to say. But yeah, just to wrap it up then. So as I was going through this downside thesis in the euro, noting the setups here and the charts, the back of my mind was, yes, this dollar is likely going to play catch up with the yields, but you've got to be mindful of intervention and what that might mean for the dollar in the short term, medium term, um, and so on. All right, so good luck out there.